Dividend investing is an excellent strategy to earn a consistent source of income from your stocks, but there are some key mistakes to avoid to make sure that you can actually make a profit instead of just losing all your money. It's not all about plowing your life savings into a company that offers a 50% yield, and there are some key mistakes to avoid from buying the wrong companies to not using the right strategy, and we'll be covering everything in this video. When I first started dividend investing, I always thought it was about finding the stock or the ETF that had the highest possible yield, looking for ones that offered 10, 20, 30, 40, 50% returns and just putting as much money as I could into them. But this was really a losing strategy because most of the time the company had spent so much money on paying out their dividends, they didn't have any money to grow the business, and this would lead to the share price of the company constantly falling. So even if you have a high dividend yield, if there's a constantly falling share price, then it's going to be hard to actually make any money from this strategy. So after this experience, there were 3 key strategies which I now follow that have really helped me actually make a good return from the dividend stocks that I buy. So the first principle is looking at the financial health of the stock. One of the main things to avoid is a dividend trap. So this is when a company will offer a really juicy dividend to try and lure in new investors, but often this is a failing strategy because a dividend is just a repayment from a company to its investors when the business is doing well and is quite profitable. So if they have a really high dividend, it's going to chew up a lot of the company's money and they can't reinvest it into the business to actually grow the business and increase its share price. A smaller dividend like 2, 3, 4, maybe even 5% is going to be manageable, but once you get into 10% plus, it's going to be really hard for that company to honor that dividend payment and actually be profitable and grow in the long term. Those higher returns are just going to ultimately lead to the share price not increasing or even falling in value. So even if you're getting a high dividend, it's not going to cancel out that falling share price. You also want to take a look at its dividend repayment history and that the dividend yield is increasing over time and being consistently paid out. So this shows strong financial health of that particular business, and one of the easiest ways to do this is to go on Yahoo Finance. So they're going to have a drop down menu that will show you what the dividend returns have been and how much they've increased over time. So really large established companies like McDonald's and Coca-Cola are going to be very stable options for you, and they have a long track record, and if they're increasing their dividend as well, this is going to be really helpful. But these companies have a return or yield of about 3%. It's nothing crazy, but it always gets paid out very, very consistently. So even big companies like Disney, which have been historically really, really effective when it comes to dividend repayments, even during COVID, couldn't honor their dividend payout. So even if it's a really big, well-branded, well-established business, it doesn't mean they're always going to be able to honor that dividend return. So really make sure you do your research on them and don't just rush into the highest yield stock that you can find. Also keep in mind the frequency that the dividends are paid out. Some of them are quarterly, so every 3 months. Others are annually, so just once a year, and this will vary on how much money you can get from the stock as well. So something like SCHD, or the Schwab US Dividend ETF, has a dividend return of about 3.8%, but that yield is spread out on a quarterly basis, so it's only paid out 4 times a year. So the total you get is 3.8%. So an easy way to make sure that you're not going to buy a failing company that's always losing some share price value is doing a quick Google search on the business and then taking a look at its 5-year return. So just as a quick example, if we type in Coca-Cola into Google, it's going to show us that over the past 5 years, it's gone up about 13%, and it has a dividend yield of 3.25%. So it's always been profitable in that time. It's actually made money as well, and it's able to pay out that dividend. And if you want to see the frequency of how much the dividends are paid out, just head over to Yahoo Finance, type the stock that you're wanting to research, and then go to historical data, and it's going to have a tab specifically for the dividends. So at the top, it's going to have initially historical prices, and then you want to scroll down to dividend only and then hit apply, and it's going to show you what the dividends have been. And you can also set the time frame. You can set it across multiple years as well, so you can go max and then have a look at the whole return that Coca-Cola has had in that time. So next we'll talk about the strategy and the returns that you can make with dividend investing. So to just give you an idea of the profits that you can get from just even a small investment on a consistent basis with the dividend investing strategy, if you put in $100 a week for 30 years into a company like Coca-Cola, which has a dividend yield of 3.25%, at the end of those 30 years your portfolio is going to be valued at $260,000, and you'll be getting a dividend payment of just over $8,000 per year. And the main thing to keep in mind is that it's definitely a long-term strategy. You're not going to become an overnight millionaire with dividend investing. It's not the same as buying a lottery ticket or gambling at the casino. It's a very slow, methodical process, but it does work out very well in the long run. But you have to have a lot of patience to invest into something for 10, 20, or even 30 years at a time and let that money grow and compound. With this strategy, it's not about spending hours researching stocks, trying to find the perfect time to buy and sell. You're just adding in to that particular business for better or for worse, no matter if the market's up, down, or going sideways as well. You're just investing the same amount every single week. And $100 might be a lot to start with, but you can start with $10, $20, $30 as well, whatever is going to be manageable for you. The vast majority of investing platforms let you buy fractional shares, so even if a stock is 300 USD per share, then it doesn't mean you have to pay that full amount. You could just buy 0.1 shares of that stock too. You don't have to buy an entire one. So lastly, what are some stocks that you should be buying, and what does it actually look like to fall into a dividend trap? So to do this, I'll be comparing AT&T to Pepsi. So firstly, AT&T has a really juicy dividend of 7.2%, which looks really great and impressive on paper. But then when you do a quick search on Google, like we discussed earlier, and you take a look at its 5-year return, it's come down 33% in that time. So if you invested $10,000 into AT&T 5 years ago, you would have lost $3,300. I know there's a dividend repayment of 7% per year, but in that time, you're going to have lost money, and that's only over 5 years. If you keep doing this across 10, 15, or 20 years, the returns are just going to keep going down or moving sideways, but the chances of you actually making a profit from this are slim to none. In comparison to a stock like Pepsi, which in 5 years has gone up 46%. So if you invested $10,000 5 years ago, your portfolio would be valued at $14,600, and that's not factoring the dividend repayment that you would get of 3.1%. So you can see how important it is to ideally pick out a company with a stable stock price and good fundamentals with a lower dividend yield, as opposed to a really high dividend yield company that is just losing share price value all the time. And after all that, it leaves the question, what are some other dividend yielding stocks that you should buy, and are there any other strategies that you can use with dividend investing to make sure you get the best returns possible? If you want to check out the answers to those questions, make sure to look at this video on screen, which will show you some other high yield dividend yielding companies that would be very worthwhile taking a look at.